Hello and welcome to Quant Matters, where we talk about the quantitative approach to investing and finance. If you've ever wanted to try your hand at forecasting, this episode is a great place to start. Our introduction to prediction covered the theory, and this is the first practical episode where we actually implement something. Today we're covering linear regression and trendline forecasting, perhaps the simplest form of forecasting there is. By the end, you'll be able to build your own trendline forecasts. They won't necessarily be great, but they are a real starting point. Before we dive in, the channel has a Patreon where supporters get access to quantitative asset dashboard and a written version of this material. Let's say you have two price points on two different dates, and you want to forecast a third price on some future date. The simplest way to do this is to connect both price points with a line and extend it out to a chosen future date. You don't even need a computer or a calculator for this one. A ruler will do. This is the most naive and basic way to do what's called trendline forecasting. And before we move on, I should remind you that all prediction is flawed by nature, since it relies on the past repeating itself, and that's never guaranteed. Our two-point trendline forecast, simple as it is, can be considered fragile because it ignores everything in between those two data points. What we would need to make it better is to incorporate more points into the forecast, and that's exactly what regression does. So how do we fix the fragility problem? Instead of picking just 2 points and hoping they are representative, we use all of them. Every single price in our data gets a say in where the line goes. This is called least squares regression, and the idea behind it is simple. We are looking for the one line that on average sits as close as possible to every point we have. Not the line that touches 2 points perfectly, the line that disagrees the least with everyone at once. Some points will sit above the line, some below it, and that's expected. What matters is that the total distance between the line and all the points added up is as small as it can possibly be. That's what least squares actually means. We're minimizing the sum of those square distances. In formula terms, this is what regression looks like. A sum of price and time pairs divided by a sum of time values square. That's really all it's doing under the hood, and the only inputs it needs are your time and price pairs. What it produces is the slope, which, while interesting, doesn't yield a prediction just yet. For that, we'll also need the intercept. In layman's terms, that's just the price the line predicts at time 0, the starting point of the fitted line. So we got our slope and our intercept. Now what? To actually get a forecast, we put them together into the fitted line itself. Then, to forecast, you take that line and plug in a future date, a t-value beyond your last data point. Out comes a price, and that's extrapolation, taking a line built from data you have and extended it into time you don't. So how good is this in practice? Let's actually test it. Using 4 assets, SPY, IEF, GLD, and BTCUSD, we fit a regression line on the first half of 2025 and let it run forward to the second half, right alongside what actually happened. In the charts, you'll see the fitted portion in one color and the forecasted portion in another, so it's clear exactly where the line stops describing the past and starts guessing at the future. A couple of these age well. GLD's line tracks reasonably close for the most of the year. IEF wanders around its line but never strays too far. SPY and BTCUSD are a different story. SPY's fitted line actually slopes downward, dragged there by a sharp dip in the spring. So when the market rallied through the second half of the year, the line completely missed it, off in the wrong direction entirely. BTCUSD's line just draws a gentle upward slope straight through what was actually a wild ride. A run past 130,000, a drop to the mid-70,000s, and a partial recovery. A straight line simply has no way to see what's coming. It can only describe direction, not the swings along the way. That's the core limitation on display. A regression line can't account for drawdowns, reversals, or volatility. It just commits to one slope and follows it, no matter how bumpy the road actually is. If you want to try this yourself, I've linked the Google Sheet in the description. It's built with nothing exotic, just the built-in slope and intercept functions most spreadsheet software already has, so you can plug in your own assets and see how they hold up. Let's briefly look at a couple of other basic trend lines using BTCUSD, since it gave the straight line the hardest time. The first is a log trend line. Instead of fitting a straight line to price, it fits one to the logarithm of the price. which works well when an asset grows steadily and exponentially, since that kind of growth turns into a straight line once you take the log. Here though, it barely bends more than our original line did, and that's because BTC's first half wasn't smooth growth, it was choppy back and forth. Log trend lines are only as good as the exponential shape they're looking for, and this one just isn't there. The second is a polynomial trend line, which lets the line curve instead of staying straight. This one hugs the historical data far more closely, almost suspiciously well. And that's the problem. Right past the last real data point, it doesn't just miss the future, it collapses towards it, curving off a cliff towards implausible values. The better a curve fits the past like this, the more suspicious you should be of it, since that tight fit is often bought by bending to noise rather than signal. And these aren't the only options either. Within trendlines alone, there are other approaches we haven't touched, things like momentum-based trendlines or tools like Meta's Prophet. Step outside trendlines entirely and you get into decision trees, neural networks, factor models, a whole world of forecasting methods, each with its own strengths, weaknesses, and assumptions about what the past can tell you about the future. Trendline forecasting is just the first, simplest stop on the road, not the last one. So that's linear regression and trendline forecasting, the simplest form of forecasting there is. And hopefully by now you can build one yourself. It might not be great because a straight line can't see drawdowns coming, can't anticipate reversals, and has no idea it's even being asked to predict anything at all. But it's a starting point. This won't be the last time we talk about forecasting on this channel. We got a lot more ground to cover, other trendline methods, other modeling approaches entirely, and I hope to get to them over time. For now though, I hope this was useful. If you want the full written breakdown, the formulas and the dashboard we used to build this example, it's all on Patreon, linked below. Thanks for watching.